Welcome to the Millionaire Next Door podcast with Robert Curtiss, CFP, accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, hey there, everyone. Thank you so much for tuning into the Millionaire Next Door podcast. Welcome. We appreciate you being here. We're joined today by repeat guest Miles Clark from Dorsey Wright and Associates. He's been absolutely terrific in the past, and these are the kind of conversations when we want to go with what's going on in markets, maybe delve into some deeper layers of our process under the hood of what we're seeing. Let folks know it's August 15th as we record this, kind of the dog days of summer. Market it feels kind of quiet. The VIX is down about 1450. Yet which is a really low number, and we're at all-time highs. So it's kind of been a slow, consistent improvement. But Miles, welcome, and let me know what you're seeing, and let's launch into it.
Yeah, well, as always, it's great to be back. In terms of, I think this is what our fourth podcast together, just talking through the methodology, talking what we're seeing from a market perspective, and how you, as a listener, can really stay on top of what markets are throwing at you. Perhaps maybe some fun before we dive into, the real market fun stuff. What have you been up to this summer, Robert? I know, like you said, dog days of summer, but did you get up to anything fun?
Yeah, it was kind of a quiet summer. We didn't go huge on any vacations or anything. I've got a daughter who's going off to college in Northern California on Monday, so we're busy getting her ready, and we're throwing a little party for her. I had a son who graduated from college, also in Northern California this summer. We did a little travel through kind of some really nice places in California. We went to Mammoth Mountain, to Yosemite, and to Monterey, which is absolutely beautiful. But that was my summer, but just working and frankly kind of grinding away here. How about yourself?
Well, sounds productive. It doesn't sound too quiet. We got down to Pensacola, Florida, a handful of times there. We've got a place, a little condo, a little bit off the beach, but it was a nice little spot. Get down with family and friends and have some fun. But like you said, it is quickly wrapping up, and where people come back from vacations, they start to get a little bit more interested in their portfolios. Of course, it's entering a seasonally weak part of the year. Or not a seasonally weak part of the year, but a historically significant September, right? You think back to other instances of September. There's a lot of big days up and down in September. So things definitely start to kick up a little bit as they move into the fall. So it's definitely worth, kind of checking in with your portfolio, with your holdings, seeing how you're doing as we kind of move into the winter months and things like that. So certainly, again, happy to be on. We got some stuff to talk about regardless.
Yeah, absolutely. It's been kind of quiet, but volatility can spike at any time. We saw that huge spike back in April. Maybe a really good place to start with was there's a study you guys did that I think might be really helpful for the listeners, talking about the value of time in the market, just to give overall perspective of as your assets are allocated for longer times, what tends to be the result. And as a side product, maybe talk about where we're at, investing at all-time highs. How has that gone historically? Yeah, I know you have some thoughts on that. So
yeah, it's somewhat kind of funny in a way, because here comes the chartist, the tactical chartist, telling you to just be in the market for a very long time, right? But there is a lot of nuance when it comes to different market environments, right? I mean, at the end of the day, any given day could bring a lot to the table, a lot different to the table. And, again, you expand out to any given week, any given month, any given year, right? A lot can look different over the course, but at the end of the day, all of us are kind of building towards something, right? We're all building towards a financial goal. And, really studies have shown that at least over the last near century, it's really just paid to own the stock market. I'll say that again. Over the last century, it's really just paid to own the stock market, own the S&P 500, and kind of putting some context around that. Around 100% of the time, right? So this is almost close to a guarantee as you can get, although we don't give those in the business. But 100% of the time, right? Over a 30-year time frame between now and 1950, right? You were up more than 1,000%, 100% of the time. So there's a lot of percentages in there, but a lot of good percentages, right? Over time, right? That changes, right? Or kind of that compounding effect can really take hold of your portfolio. You look at that over a 15-year time frame. So instead of a 30-year time frame, just half as much, you are only up over 1,000%, 5% of the time, right? And so that value of time in the market is certainly very important when it comes to protecting your portfolio for the long term. Does that track?
It tracks completely, and you just made me aware. As you know, I do this day in and day out, right? And I've been doing it 28 years now with second and third generation clients. But there's been all these issues and incidents and yada yada. But I literally remember people with $350,000 portfolios that are now at $2.5 million or that kind of thing. It just took time and the process of kind of weeding out things that might not have been working and sticking with winners. But yeah, as you zoom that lens further out, I mean, it sounds sort of like, hey, just stay in the market. We're not just saying that, but we're stepping back and looking at what the data actually says, and it does. It completely jives or tracks. But that's really interesting. Tuning it back out, a lot of the noise goes away, and then you mentioned that percentage. I mean, it's never not happened. We can't say for sure, but that's the history. So that's sort of my response to that.
Yeah, and I mean, it's of course, like you said, you can't make the guarantee. Of course, you and I are talking about it, so just our luck, it probably won't be like that over the next 30 years, right? But kind of you mentioned in something there, you just want to be in the market, except sometimes it does pay to be tactical in there, right? That's kind of the but. So the kind of further point of that study is the actual annualized returns over the 30-year time frame. So the max annual return, again, over that since 1950 to today, over a 30-year window, the maxed annualized return is around 14.82%, 14.62%, excuse me. That's pretty dang good. If you could go out and compound your money by nearly 15% a year, that would be great, right? The minimum over that time frame, right, is still positive. It's around 8.78%. Again, that's probably about average over the long term. Now, the point that I'm trying to make here is that there is a whole lot of real estate in between a portfolio that compounds at 8.78% versus one that compounds at nearly 15%. And so, being tactical, yes, you want to be in the market as much as you possibly can, but being tactical in your allocation can really help you get up to the kind of upper portions of that 15%, over the long run, because you can figure out when you want to be offensive, when you want to be defensive, and again, get you, closer to that 15% than you would be to the kind of longer term averages.
Yeah, for sure. I mean, both those are productive, 8, 15, but the tactical, I feel it's really important right now. One of the things you may want to comment on is just sort of this waning participation. It's been so consolidated, and why tactical really matters right now. Kind of where do you want to be on offense? What do you want to avoid? What are your thoughts there?
Yeah, over the course of the summer, we have seen participation drop off quite notably. And now let's define participation. If you're a listener of this podcast and you might have heard me, and maybe this is your second or third time listening to me drone on for an hour or so, but participation as we define it is the percentage of stocks within a given universe that are moving up or moving down. And it doesn't take an expert to know that we want participation to be moving up, right? So the more stocks that are moving up, the healthier the market environment typically is, the more productive kind of the overall market can be at any given point in time. But I do want to put in sort of small caveat is that participation does not always equal performance. And I'll say it again, participation does not always equal performance. You think back to 2023, right? 2023, the market overall was a very strong market, right? The S&P 500 ended up the year over 20%. But when you looked at the participation readings underneath the hood, it was really just the Magnificent Seven that were doing all of the heavy lifting. So again, this is one of those instances where, again, participation was low, but your overall performance was strong. And it isn't that evident here in 2025 that that's what's occurring. But at the same time, you are seeing a bit of a decrease in participation, a bit of a rotation back into those Magnificent Seven names that are, again, doing the heavy lifting over the last couple of years. This isn't really a red flag, but I would say this is a yellow flag for right now. Again, we're going to be still bullish on domestic equities, bullish on international equities, but the proportion of the names that are advancing is a tad concerning, to say the least.
I think that that kind of jives with the way my tactical approach. What you mentioned, a yellow light, still bullish. If we're at an intersection, we're going to proceed through that. We're not going to, hit the brakes, but we're going to be cautious and maybe check both ways and be, a little bit closer, know where that brake is, just mindful of where we're going through that, cautious like you would through a yellow light. I think that's 100%, in tune with what we're doing here. And what about also, I did want to comment sort of folks going in at these kind of all-time highs. What, I'm not sure if you commented on that. What does history suggest about that in your study? Is there data that makes a clear message out of that or not so much?
Yeah, and it's more of really the same that we looked at before, which is essentially it just pays to own the market, right?
Okay.
Day in and day out, when you are buying a market, right? I understand it, right? Psychologically, it's very easy, and I deal with this with my friends and my family all the time, and they're like, "Well, Miles, like it's never been this expensive to go out and buy the market. Maybe not from a fundamental perspective if we're looking at PE or something like that. But point is, right, it has never cost this much. We're at uncharted territory, right? People can get a little bit scared buying around uncharted territory. The point is that we did a study that looks at 3 hypothetical portfolios. Okay, the first is what we call our average Joe portfolio. This guy, simply since the year 1950, contributes to a hypothetical portfolio $100 each month, and he does it no matter what. So that's going to be our first portfolio. It's kind of simulating a retirement account or something along those lines. We then have 2 other portfolios. The one is going to be a skeptical investor, which invests the $100 each month, but then holds the contribution in cash if we're at all-time highs and we're overbought. So that's like a Dorsey Wright reading of, hey, like, are we at all-time highs and is the market too hot right now, right? And then he will deploy all that cash whenever the market isn't at all-time highs and is kind of normal, right? And then you have a third investor who is nicknamed scared investor. He does the exact same thing. He invests his $100 each month, but he holds his contribution if we're overbought and at all-time highs, and he holds it until we're oversold. So he's the guy who waits for the pullback. He tries to time the market. He tries to make sure that he's getting a fair price for his assets. The point of that is, and again, if you didn't kind of track all that I'm saying, there's 3 portfolios. The average Joe portfolio does the best, right? The one who just continuously buys the market over and over and over again, despite being at all-time highs, despite being overbought. The average Joe portfolio, the one that, again, is not scared or skeptical in any way, is the one that, from point to point, does better.
Okay. Yes, it's certainly a simpler process. And then, we always see these interesting things, too, underneath the surface. That's one of the things I really like about your research. Like one that just stood out recently, you mentioned tactical. A lot of things are seemingly counterintuitive. For example, these sort of green type stocks, you would think on a federal level, some of the plans to phase out or eliminate these energy credits, you would think they'd be really disadvantaged and not doing well, but we're not seeing that. It's just the opposite. That just came up as one example. Any thoughts on that or anything else kind of that's just very initially counterintuitive until you really dig down and see what's going on under the surface?
Yeah, I mean, the solar stuff, or at least kind of like the green portfolio sleeve, that certainly comes to mind. The one, of course, that comes to mind more maybe on a broader scale is going to be international equities, right? When President Trump was elected last November, of course, you kind of go into that. That's going to be America first, anti-international, tariffs, things along those lines. But here we are, and international equities continues to storm forward, and we're seeing some signals that international equities are really points of strength over domestic equities. Now, again, domestic equities still hold longer term strength and things like that, but for the most part, right, that's going to kind of fit into that. And the alternatives or the solar, that's going to fit along that same. That's not necessarily in Trump's wheelhouse. You would probably go and bet. The point here is that price is going to tell you, right? There are a lot of headlines that are swirling around, right? Hey, is Trump bad for internationals? Is Trump good for domestics? Is Trump bad for green energy? Or, about the energy credits. I'm not trying to make this a whole Trump thing. But yeah, the point is that price will tell you what the market is actually thinking. So, while there is headlines the whole way up of, hey, this doesn't make sense, it's not, well, it's not practical, whatever it may be, price is ultimately telling you what direction or what specific assets are doing well at any one specific point in time. So following that price and latching onto those trends over time can help you actually see through what might initially be counterintuitive. Because again, initially counterintuitive to think that Mexico would be doing better than or would do well underneath a kind of Trump administration, but it's kind of worked, right? And so that's that price following can help you look through those headlines.
Yeah, and interesting. I know on the just political front, or maybe you guys have done some work, but stuff I've read, as much as you would think, a Republican, a Democrat, whatnot, historically, really they've kind of worked out about the same for the most part. It kind of falls into that bucket of the time in the market and that longer trend. And if you got too worried in the macros, or I can't go in because this person's in office versus that one should be better, that it just didn't really work out that way, and time took care of it. Is that sort of what you show historically, or did you have any? I know you've run studies on this in the past, but basically the market's just sort of been climbing this big wall of worry, and it seems to do that a lot. And we're in a strong bullish market that it wouldn't get to these high levels unless we were, in a very productive sort of market in the first place. But curious what you're thinking around that.
Yeah, so I think we talked about this maybe the first time I was on when we were just kind of talking about elections. Markets hate uncertainty, right? I mean, that's at the end of the day. So to actually answer your question, no, it doesn't seem to matter in, a convincing way, whether you've got a Republican or a Democrat in there. Now you've got averages, right? Like you've got the financial crisis, you've got, COVID, you've got, there's stuff that is an outlier. But, there is largely no difference in between kind of long run averages in between Republicans and Democrats. What is interesting is going to be the presidential year or what part of the term we're currently in, right? So you look historically, and the second year is typically somewhat of an unproductive year, right? Because there is uncertainty, right? We talked about midterm elections. We don't know what direction the overall political schema wants to head in, and then you digest that, you move through the midterm elections, you go into the third and fourth year. Ultimately, markets then are able to know what is happening, right? And then, fourth year peters off a little bit towards the end as, a new election comes into play. And then the first year is also overwhelmingly positive, right? As markets know what the president-elect is going to do. They know their general policies. They can rotate into those assets, and things are relatively transparent. So again, the message of the story is markets really just like to know what's going on, and they get blindsided by when things aren't as expected, and that is then realized into the price. So yeah, that would be the case for that specific instance.
And that makes a lot of sense. When there's a change, the market wants to parse it in. And certainly with this administration, there was all kinds of change right out of the get-go, just very quick tweets and day changes. And that uncertainty was a little unsettling, but it's starting to get a little bit more clear.
Oh, yeah.
Yeah.
I got a question for you, just out of curiosity. In terms of crypto, and I know we can get way in the weeds in crypto, have you seen, with Ethereum and Bitcoin kind of rallying up to highs, have you seen clients getting more and more interested in crypto in their portfolios and things like that? Again, tread lightly here. I don't want to go make it seem like we're going long in crypto in the retirement accounts, but just curious.
Yeah. So I get asked about crypto periodically, and I think it's just out of curiosity or maybe some FOMO. Most of the folks I deal with, sort of these millionaire next door, they're not that interested in going into it. And frankly, from a compliance perspective, we have some issues around that and some limits on that. So we're generally not going to go that. I will tell you on a personal level, I don't have any in there myself. That's just my own personal. I can't pay my taxes in it. I can't pay for your services. Nobody can pay me. It complicates your tax return. I don't feel this FOMO given the other choices that are out there. I feel it's pretty speculative. So I let people know what I think. Most of the time, in my case, they're not that. They weren't that interested. They just want to get the thoughts because they've heard about it. Other folks do go out and purchase it, at away, and they're comfortable holding that for whatever reason. I'm usually not involved, but I know your system charts, all these relationships with, there's still many, probably 150 choices within crypto, right? So where are you going to go? But that's sort of my experience with it. And I don't know if that answers your question there.
No, it does. I mean, the reason for asking was we've got some more, calls in recently, and obviously those calls occur when Bitcoin is surging. So, people do have that FOMO. I guess the reason why I was asking was because, like you said, you've got a bunch of different available options to you. And, it kind of brings me back to that participation conversation that you and I were having earlier in the call. That was, knowing what's driving assets forward. Now, in this case, right, the Bitcoin is the one who's driving forward and things like that. But going back to the participation just for a moment, you take a look at a sector like healthcare, right? And healthcare has been a laggard on the Dorsey Wright system for quite a while now. As UNH and Eli Lilly and things like that, they struggled. But knowing where participation has left can be good because, again, what stocks to pick within a given sector. So, for instance, technology, a leader from a performance perspective, but in terms of participation, it's narrow, right? So, within technology, you need to go out and just select a handful of stocks that are doing well because not a lot of them are participating. On the other hand, right, something like industrials or communication services, right, those sectors rank well and their participation readings are higher. That you can essentially throw a dart within those sectors and go out and, get a stock that's performing quite well. So again, just to put a button on that participation conversation, it's, useful because you can go through, look underneath the hood and identify, hey, is this sector doing well because of just A, B, and C stock, or is it doing well because of the entire alphabet worth of stocks, and then allocate as such within your portfolio tactically?
Yeah, that's a good point. I mean, to the extent we can find those sectors where you almost could throw a dart, then that's a great space to be, right? There's a much larger trend and it's all participating, maybe like cybersecurity, that kind of thing, but Other things we do see, and through your system, you identify, weakness, like in healthcare, what is going on there. There's probably a lot of things going on, a lot of changes at the federal level, but it's just not working. So there's so many levels. I explain to clients and folks I work with, all the models you have where we see certain things move in, move out, how we bake a lot of those strategies, sort of like momentum or relative strength strategies in there as one, as one sort of strategy or asset class, and why that's been really successful over time. I think it's really helpful for clients in terms of participating in winners, avoiding losers, and noticing when things are changing over. And it's all, it's all relative. I think of it sort of like a sports team. If you're a top level NFL team, it's going to be very hard to get on that roster and play, right? They're going to probably turn away tons of excellent athletes, but they're trying to put the strongest team on the field at any given point for whatever, the goal is to beat their opponent. So
yeah, I think
helpful.
I could probably go out and get on my team. The Saints they're putting a pitiful group of guys out there. So I think I could, if anyone on the Saints organization is listening and you need a backup wide receiver, just let me know. I can probably come out to training camp in the next couple of weeks.
Wow.
But I'll tell you this on a serious note, momentum's still doing well. You and I were talking about before the call what we were going to chat about, and I was like, yeah, nothing's really changed that much. Leadership has been consistent, things like that. Those are actually going to be the most beneficial markets for momentum, right? When your leaders just continue to do that, when they just continue to lead and your laggards continue to lag, right? Those are going to be the ones where momentum is able to grab onto those trends and ride it essentially until the cows come home. And then ultimately take advantage of that rotation, if there is ultimately said rotation, gradually over time. So an unproductive, an unexciting market environment can actually typically be the most exciting for momentum and kind of trend followers, because unexciting means, leadership is not changing. Let's put it that way.
Interesting. So yeah, it works out. And, thematically, I've focused a lot on just continuous improvement in everything, my business, my practice, my health. But, I referenced this very early on in one of the podcasts. One of the big strategies, speaking of sports, the LA Lakers, way back when they were this championship team with Showtime, their coach came in and sort of, they were struggling, but he instituted this sort of continuous, steady, but even incremental 1% to 3% improvement on a continuous basis. And it's unbelievable what kind of change that drives over time, as long as that's ongoing. I thought of that as an analogy a little bit. We're seeing continually improving things that can change, but it doesn't have to be a big, huge wow. A 10% improvement is probably way too much to expect. So it's interesting to see in your context that actually works productively for some of the techniques you use, and that's actually very productive and not that exciting. And I love it. I love it when things are steady but kind of slowly moving up. It's generally quiet and things are moving in the right direction, but without a lot of stress or worry for the most part. If that's what you're saying.
It's such like reverse psychology, right? Because people, I think, they think about building their overall financial picture or their retirement plan or, whatever it may be, right? And they're like, oh, well, it should be exciting, right? And it is exciting in one form because they're gaining financial freedom and they're setting aside things and, achieving goals and things like that. But at the same time, the returns itself, the profile of returns, should not be exciting, right? You don't want to, look up and be, oh gosh, I'm up 20% today, or I'm down 20% the next day, because that's much less exciting. Gradual improvement over time and kind of standing back as you look at the kind of the history or progress that you've made over the course of your lifetime. That's what's exciting. It's not necessarily, waking up tomorrow and realizing that your portfolio value has, doubled or tripled. I think that's probably a good takeaway for clients listening.
I think it's great. Thematically, the Millionaire Next Door, the overnight 25-year success story, it does take time. I had someone who was introduced to me several weeks ago looked at their outside, all their investments, even their 401k, they're like early 50s, and husband and wife each have about $1.4 million they've been contributing the max just in a 401k. But that's a pretty successful formula. And then they asked, do you think that this sort of formula works of just allocating, doing this? And I'm like, you guys, through sort of a middle class income, have created this kind of result. I mean, yeah, I think it works. You're going to be at it for another decade or two. Where do you think that's going to be? And then sort of the tactical guidance of keeping it in the right places and avoiding stuff that isn't. So that just jives with the kind of stuff I see on a day-to-day basis and the kind of advice and thought partnership we share with clients. So any quick closing thoughts? Or, I mean, it's great having you on. You're sort of a regular because initially we thought there's not that much to talk about, but there always is. So curious if you have any kind of closing thoughts, and appreciate you being here.
Yeah, I mean, closing thoughts, things are undoubtedly going to start picking up as everyone gets back from their beach vacation to close August. So, closing thoughts, domestic equities and equity spaces in general with international equities as well, continue to kind of flex their muscles at the top of the rankings. We aren't seeing, any real major signs for concern besides the kind of participation commentary that you and I discussed earlier. Sector leadership remains largely consistent. And, from a psychological perspective, for you listening, just continue to dollar cost average into these areas, continue to, believe in the saying, time in the process, not timing the process, as we kind of looked through over those historical studies as we opened up the call today. So again, really appreciate it. I look forward to next quarter. Things, like I said, will undoubtedly be bouncing around, things like that, but we're going to do our best to cut through the noise.
Fantastic. Yeah, the noise canceling headphones. I love it. So you're a really helpful part of that process. We appreciate you coming on and sharing. And thanks to everyone for listening. We appreciate it. Please like and share this, and reach out. Let me know if you have any specific questions or this raised anything for you. Enjoy the rest of your summer and go out and make it a great day.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors or Royal Alliance Associates Incorporated, member FINRA SIPC. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.